Are we on the cusp of a new era for silver, gold, and precious metal mining stocks? You might feel crazy after being invested in this segment over the last decade or so. Today, we have a special guest, Oren from Silver Hermit. That's his YouTube channel. He's going to tell us his story, how he got into precious metals, but he also has some critical information that might just have you feeling like you're not so crazy by the end of the video. Oren, welcome to Ron's Basement.
Thank you. Thank you for having me. It's a
Well,
pleasure to be here. It's a pleasure to talk to you. I feel a bit excited because I've been following your work for quite a while, and it's such a pleasure to talk to you in person. And I just admire your perseverance, your ability to do your videos again and again, even though we're in a time in which the precious metals haven't been doing so well, and you stuck to it, and it's something I really appreciate. So great being here with you.
Wow. Well, it's our honor. You've done some extensive work over the years in terms of the metals, looking at the economy. The people that are joining us right now for this conversation obviously are interested in the metals as well. Why don't you share with us kind of your background and what got you interested in silver and gold?
Well, it's a long story, but it starts with the 2008 financial crisis. And, I had a business back then. I was just starting. And, suddenly you're hit with a financial crisis, and everything halts, and all your projects are canceled overnight. And suddenly you find yourself, with no work. And this is what taught me that, look, there's such a thing as a global economy, global financial markets. You have to be aware of them. You need to know what's going on because it can affect your personal life. And as I got interested in economics, the more and more I realized that things are not well. That although apparently the crisis was over, the underlying problems were never solved. And as a matter of fact, things, they were exacerbated because of the policies of central banks. They just, they swept things under the rug, so to speak. That they just, they kick the can down the road, and that we're going to meet that can somewhere down the road. And I was convinced after doing some research that we're going to have a crisis, a much larger crisis than the 2008 financial crisis. And frankly, I'm amazed that it took so long. Because on every step of the road, they managed to postpone things a bit further.
And so let me, Oren, let me interject a question. You talked about kicking the can down the road, and I think you're also talking about escalation as well. I like to use this analogy that, like, maybe during the tech bubble burst, they kicked the can, and then, in subsequent crisis, the great financial crisis, the can turned into more like here in the US, we have 5-gallon buckets, and you can still kick a 5-gallon bucket. And then when the C-19 crisis hit, they kicked it, it was more like a big giant industrial trash can. And now, like, the can, do you think the can is getting bigger?
Yes, definitely. That's a great analogy, because there will come a point, and of course, many analysts have used this analogy. There will come a point when the can is so big that you can't kick it anymore. You'll break your leg trying to kick it. And are we there yet? I don't know for sure. None of us know for sure. We're guessing that, yes, perhaps this is the time when they can't postpone it any longer. And the insight was that inflation was the true reason why you can't fix the economy any longer, or by printing money. Because now that you have inflation, they can try to print some more money and bail out the system again. But this means that inflation that has subsided somewhat, it will erupt again. And with more intensity. than we had in the past 3 years. And so they're trapped. Central banks are trapped. They can either let the entire financial system fall, which is deflationary, or they can let the system explode, burn in a inflationary fire. So it's either ice or fire, but they have to choose a path. And I think they've been trying to walk in between the ice and fire all the time. But there comes a point that they can't do it any longer. I think they're very close to that point where they have to decide, and finally markets are going to take the decision out of their hands. If they try to postpone it any further, markets are going to decide by themselves where we're going, where we're headed.
Yeah. First Mining Gold is a development company advancing 2 of the largest gold projects in Canada. Springpole in Ontario and Duparquet, located in Quebec, each already has 5 million ounces of gold reserves, but exploration initiatives are underway at both projects to find even more gold. First Mining is well-financed, has 0 debt, and owns an interest in 4 additional Canadian gold development projects.
I like to say Mother Nature always wins in terms of, the forces of nature, the forces of the market always win. I have a question for you. I want to get your opinion on this because you talk about the choice between ice and fire, right? Either hyperinflation or a deflationary
Hyperdeflation, yeah. Hyperinflation or hyperdeflation.
We're going hyper one way or the other.
Yes, that's the problem. Everything has gone to the extreme. We're living in a time of extreme, and now we're suffering the consequences of those extreme.
Yeah, but I like to say, Oren, that the system, another way I like to describe it is that the system, because of the escalation and the exaggerated manipulation and perversion, or however you want to say it, that the whole system has become much more sensitive and delicate and requires even bigger action and quicker action. And people always say, oh, well, if the economy gets bad or the market goes bad, that gold and silver are going to crash. And I say, well, maybe not. I mean, maybe things have changed. Maybe the system and the reactions have become so extreme and so expeditious that gold and silver and the metals will not have to go through that period that we could see. But, does that make sense?
Yes, I understand your questions. That's a question I don't have a good answer to. I mean, there are 2 possibilities. Of course, the first one, as we've seen in past instances of crisis, that at first we see the precious metals, the prices fall. Because of the industrial demand falls, then initially you get the price falls. But of course, the Fed does not allow any kind of deflation. So they always react to any bit of deflation by inflating the system again, by injecting all that liquidity again. And then the markets start reacting, because the metals, they have the 2 hats. I call it the 2 hats. They have the industrial side and the monetary side. So at first, because of the industrial side, the precious metals fall. But then they react to the monetary side due to the inflation. They start picking up, the price goes up, and it goes up higher than it was prior because of inflation. So I don't know to tell you. I can't tell you whether this time we're going to have the initial fall, the initial deflationary fall, or the markets have finally realized that after the deflation, you're going to have inflation. So perhaps we're not going to have the dip, and we're going to see them just take off immediately. I don't know. We don't know. But this means that we can't afford to wait until the price. We can't be smart about it. We can't be cute about it. We can't say, oh, perhaps the price is going to fall. I'm going to wait, and then I'm going to start stacking. Well, first of all, you don't know. Perhaps the price is going to fall, and you won't be able to get any physical metal. That is also, or the premiums are going to shoot up. And then it's going to be as though the spot price is going to fall, but you won't be able to get any metal for that price because of the premiums. That is, we don't know. Or perhaps it's going to just take off instantly overnight. Everything is possible. So you need to have your position in advance and keep it physical, keep it without debt or leverage. So you have staying power. So you can stay in the game for a long while, even if the price doesn't move for a while, or if it falls, so it doesn't affect you too much. Make sure that you stack with money. I always give this advice. Make sure you stack with money that you can afford to either lose or not use for a long while, because it has proven itself. Like we've been in a continuous consolidation for 3 years now, which is amazing. Like we've had incredible inflation all this time, and the prices of the metals hasn't moved at all. It's mind-boggling. So, but that's what we have, and we have to somehow survive. We need to get through this crisis, which has proven to be a lot longer and deeper and far-reaching than we could ever have imagined. Look, when I started on this road I started writing about economics in 2013 in Hebrew, because I'm from Israel, and at the time I could not have imagined that it's going to take more than 10 years for that crisis, which I anticipated, that it's going to take over 10 years to manifest itself. But the good side is that, it gave me time to stack, and it gave me more time to get prepared, and it gave me more time to study those markets and prepare myself, both the knowledge, the aspect of knowledge, and both emotionally, get prepared emotionally for a crisis. And now, for the first time, just recently, I started my YouTube channel, and I'm trying to give this knowledge and experience to other people as well, because I think it's so important, and I think this time is getting critical.
Yeah. And I want to encourage everyone who's watching us right now. I think they have a good idea that Oren knows what he's talking about and has some great content. So I want to encourage everyone to go check out the channel at Silver Hermit on YouTube. Okay. And I'm going to have links in the description of this video as well to his Substack and any other ways that Oren wants people to be able to reach out. Are we crazy? Right. That's what we started out with. We feel crazy, right? It feels crazy because I want to back up. You talked about your journey into precious metals. I had a similar type journey as well. And I think that you're obviously a very intelligent guy, and I use whatever horsepower I have, mental horsepower, to dig into money and the financial system. And it becomes very clear that at least it did to me, that the gold and silver are the answer, at least from what I was able to dig up. So it does feel like we're crazy over the last 3 years, and share with us, if you will, because we look at things like the S&P 500, we look at things like the market caps of companies like Microsoft and Apple. And we compare that to the performance that we've had with either the physical metals, silver and gold, or even the precious metal mining stocks. And we can feel like, oh, we're wrong, or we're crazy, or we made a bad decision. But you've pointed out some interesting, facts about the markets. And do you care to share any of that with us, Oren?
Yes. Well, as you said, my message to stackers, people who appreciate gold, silver, but also just people who have some common sense. And my message to you is, as you said, you are not crazy. Why? Because things in the financial markets have been very strange for a long time, for a very, very long time. And the thing is that when things are acting so strangely and counterintuitively for such a long time, then you start getting used to it. And people on Wall Street, they are certainly used to it, to the extent that they think that it is normal For instance, this saying, bad news is good news. Where does it come from? Because for a long time, whenever there was bad news about the real economy, then the Fed would come out and ease some more, or had an excuse not to hike rates. And of course, that meant that there was another infusion of cheap money into Wall Street. I hope to explain how in a short while, the connection between the two. And that meant that the worse it got for the real economy, the better it got for stocks, for the stock market, for Wall Street. So they started thinking in a counterintuitive way, in an inverse way, and it's not supposed to be this way. Look, eventually the stock market is supposed to be somehow linked with the real economy, and this disconnect cannot last forever, even though it has persisted for over a decade and people have just got used to it. But I'm telling you, it makes no sense. And if you have an inner feeling, if you have an intuition that it makes no sense, I'm telling you, you're not wrong. I know it's been very difficult to believe in yourself, because you're constantly, if you're acting according to common sense, if you try to think rationally about the markets, you haven't been able to make any money in these markets. They've done the exact inverse of what you'd expect on each and every turn. And one of my videos addresses this conundrum by explaining how on every turn in the past decade, whenever there was any danger that the bubble in the stock market would burst, the Fed was there with another infusion of cheap money, with 0% zero interest rates, and with QE, and I'll explain how the two are linked, because that was not very easy to understand, how QE could affect the stock market. You know, to this very day, there are many economists and analysts who claim that QE is not inflationary. Some of them even claim that QE is deflationary, which is, you know, it's completely silly. Like the Fed can print money and somehow this is supposed to cause prices in the supermarket to fall. No, that's not true. The thing is that QE, although it is money printing, it does not affect the stock market directly. It affects the stock market indirectly. And this is why it has baffled so many analysts for so long. Like the people, ordinary people like you and me, have a gut feeling that printing money leads to inflation. Mm-hmm. But it's difficult to understand the path in which this money seeps into the real economy. You know, it does so in a very indirect way. And I'll try to explain very briefly. Now, the thing is about QE, quantitative easing. When they print money, they give it to the banks, right? They buy bonds, government bonds from the banks. And the banks receive that money, but they can't spend it. Why can't they spend it? They spend it because it goes to their accounts at the Federal Reserve. And that money, which the Fed creates out of nothing, is called bank reserves. And the thing is, there was a time in the past where banks needed to have reserves as collateral for the bonds, for the loans that they gave to the public. They needed to have some reserves at their accounts at the Federal Reserve. And for instance, for every dollar that they kept as reserves, they could hand out $10 of loans. Mm-hmm. And this way, the Fed, by regulating the amount of reserves, they could regulate the amount of loans which the banks issued to the public. And this way, they had sort of a control on the amount of credit which was created. And also the amount of inflation, because of course, the banks, through the system of fractional reserve banking, the banks they themselves create money out of nothing. But the thing is that after 2008, the Fed has done so much QE, and so much bank reserves have been created, that there was an excess of reserves. It means that the banks had more reserves than they needed for the loans that they gave out. They didn't know what to do with those reserves. So they just kept those reserves, and the Federal Reserve has given them interest, paid them interest on those reserves. So they had an interest to keep those reserves at their accounts with the Federal Reserve. I know it's kind of complicated. I hope I haven't confused anyone.
No.
The thing is, but you need to understand that money stayed there, locked, and you as a person, at least as an analyst from Wall Street, you see, oh, the Fed has printed money. So what? It is sitting in those accounts. It's not moving anywhere. Yes, the banks are receiving interests on it. Okay, this way some of it can seep into the market, but that's just a small amount of that money, of those trillions and trillions, and you can say, okay, so QE doesn't affect the market, but there is a path in which QE does affect the market. And that path is through the demand for government bonds, because what QE has created is an artificial demand for government bonds, because it has, of course, it comes to the banks and tells them, oh, dear banks, please sell bonds to me. So the banks need to go and get those bonds from somewhere, those government bonds. And for those who don't know, there is an inverse correlation between the price of a bond and its yield. I know it's a little tough to understand, but it's a bit like a seesaw. Like the price of the bond goes up, so the yield goes down. And the other way, the price goes down, yield goes up.
Yield goes up.
Okay, so if you create artificial demand, so you push the price up, so you push the yield down. Okay, so what QE has done, it has pushed long-term interest rates down, and this way the Fed could affect also the short end, which they decide, and the long end of the bond market. But okay, so this is another step on the road to the stock market. The next step is that the moment investors, they can't make any yield, any return on their bond portfolios, because yields are so low on their government bonds. So they have no choice but to go and buy corporate bonds who offer a higher yield. So the artificial demand for government bonds has created an artificial or an increased demand for corporate bonds. Oh, now you're getting closer to the stock market. Okay? Why? Because those companies, and especially in the past 10 years, it's been the large tech companies, they've been able, thanks to QE, to borrow very, very cheaply. Borrow from the public very cheaply. Again, this is not directly, this is not the money which was printed by the Federal Reserve, but that money forced the public to lend those companies very cheaply. And okay, the original plan, I'm guessing, was that those companies would use this money in a beneficial way in order to hire more workers, develop new products, open new factories, do something creative with that money, right? Generate growth. But that didn't happen, because those companies, the managers of those companies chose to do with the bulk of that money that they were able to borrow very cheaply, they used it to buy back their own shares. What we call a share buyback. And now I'm not completely sure about it, but I believe that this was the main driver behind the bubble in the stock market that we are seeing nowadays. Now, I've crunched the numbers, and I've reached the conclusion that since 2008, S&P 500 companies have bought back their own shares to the tune of $8 trillion. Now that's big money.
Wow. That's that. And let me interject something as well. That's with borrowed money. That's
not exactly. They used that 8 trillion, of course, includes their earnings, their legitimate earnings. But I estimate that about 25% of that sum, $2 trillion, were borrowed. So they used $2 trillion. Out of that 8 trillion, which I mentioned, 2 trillion were borrowed from the public. And so you need to understand that $2 trillion that were not supposed to reach the stock market were used to buy back shares. The companies used them to buy back their own shares. And it wouldn't happen unless there was QE all along. It just couldn't have happened because rates would be much higher, the cost of borrowing would be higher, and the companies would not choose to do such a thing, because a share buyback is something which a company does. Well, first of all, we need to say it's legal in the US. It's considered legitimate, although it's a very nefarious business. Because a company, when it buys back its own shares, it can push up the price of its own share. And the managers of the company, they are incentivized to do so because they get paid according to they get incentivized. They get their bonuses.
And it reduces the number of shares outstanding, which will pump up the earnings per share number to a certain degree as well.
Right. It creates the appearance as though the company is more profitable, although it isn't. It's simply reducing the amount of shares outstanding, and then you have more earnings per share. It's just an illusion. Everything is just an illusion.
Yeah, and to the extent that debt is used to accomplish that, it further indebts the company as well. I mean, in a short term, I mean, if at some point, if IBM bought back their stock with borrowed money at $100 per share, and at some point in the future the stock goes to $50 per share, they still owe that big amount.
If you're looking to buy gold, silver, or platinum, do yourself a favor and check out Pimbex, the online precious metals bullion dealer and sponsor of Ron's Basement. I was a happy customer before they offered to support the channel. You'll find they have the best prices, quality, and service. I think Pimbex is best, and you will too. And be sure to tell them that you're from Ron's Basement.
Exactly. So in order to boost the price of the share on the short term, they took huge debt on themselves, which, they still have that debt. They still need to pay it back. And now interest rates are rising. So it's going to be more difficult. Now, it's true that at the time they borrowed very cheaply. Interest rates were very low. It was very tempting to take that money because, interest rates were very low. But they don't have enough money in order to pay back that debt. They don't have just, 2 trillion lying around. Okay, let's suppose they do have some money. Let's suppose they do have some money in the bank. I haven't looked at all the companies' balance sheets to see what's going on. Let's say they have enough cash to pay back some of it. But that means they can't do any more share buybacks. People in Wall Street, they are expecting those share buybacks to continue. But they can't, because if they have to pay back that debt with their earnings, then they can't do any further share buybacks. That's one thing. But also, if they can't, you understand what I mean? It's compromising the stability of the company on the long term in order to get the stock to rise on the short term. Now there's another problem with that, because if they need to refinance that debt, okay, it's supposed
that was my question for you, because I don't know, but like on average, what's the length, what's the term on the debt where these, because that that could have a major impact as.
I haven't checked that.
Yeah,
I
was
need
just
to do
curious.
some research on this. It's
Yeah.
interesting because look, we have data regarding very available data regarding the maturity of government bonds in the United States, for instance. But in order to do that kind of research on the large tech companies, that would take some work. So I'll see if
we
I'm
do
able
know,
to access that information.
Yeah, but we do know that at minimum, it in the future it will roll, right? I mean, there's going to
Yes,
be,
of
it's
course.
going to roll, and if unless rates go back to zero, most likely all of that debt that the big tech companies took on over the last 5-10 years is going to
Now, there's
be.
another point. There's another
Yeah.
problem that if they can't refinance that debt because rates have gone up, they may need to issue more shares to
Yeah.
go back to the stock market and raise money through the stock market in order to be able to pay back that debt.
Yeah.
And that means that is the inverse of a share buyback.
You took the words right out of my mouth. It's the inverse, right? The
Yes.
hens come home to roost, right? That's a saying here in the United States. The hens come home to roost, and it's an inverse action where they have to go to the market and raise capital through issuing shares, and it's the exact opposite.
Just like, after a party you've had plenty, alcohol to drink, and then
Right.
you have the hangover.
Yeah.
Like
Yeah.
it's payback time.
Yeah. 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 And the whole tech sector, right? And there's some great companies, and they're doing wonderful things, mostly wonderful things. And but even the S&P 500 in general, it's totally disconnected from fundamental reality. I have a degree in accounting. I understand. I know you do too. Balance sheets, and it's all completely dislocated from. I mean, a lot of the big companies have more debt on their books now than they have actual book value of assets. They're like upside down. It's crazy. The other thing I want to throw in too, and there was some recent Fed, I think it was the New York Fed, put out a report that like 10% of the mid-sized companies in the United States are what are considered zombies now, right? They can only survive in a 0% interest rate environment.
Yes.
The only way they could survive was by borrowing more money. And now that we're in a higher interest rate environment, it just doesn't work.
Yeah. Well, I always say the notion of 0% interest rate, it was always obvious that it's unsustainable because you can get in, but you can't get out without a crisis. And it was crazy to go ahead with it in the first place. The Fed should have known that it's completely reckless, completely dangerous to go there. I think that by law, interest rates, short-term interest rates shouldn't go below 1%, because it is, I think, to the best of my knowledge and according to my research, it is impossible to get out of anything less than 1% without causing a financial crisis.
Yeah. So, Oren, are we crazy? Or when we look at what's going on on the other side, what's going on in the mainstream markets, when we look at that seems to me to be a little crazy. But like you said, for now, we're dealing with the situation where that narrative continues, that story continues, but it sure feels like we are heading towards some very challenging times.
Okay. We're not crazy. We were made to look crazy. We were made to seem crazy by the constant interventions of central banks around the world and their constant manipulations. And I don't care if you're one of the people who believes that there is, the price of gold and silver is actively manipulated, the COMEX or not. Even the things that we do know formally, all those interventions by the Federal Reserve and the ECB and the BOJ and all the central banks, that is enough to create a huge dislocation in the market. And like we had the hunch that stock market keeps going up and up and up, but commodities keep going down and down and down and down. And we were taught back in the day to look for value, to buy low and sell high. That was like the principle. You're supposed to buy something which is undervalued and sell it when it is overvalued. But in the past decade, it just didn't work completely. Right. So things that were already overvalued, according to all sorts of measures, all sorts of indicators, kept going up. They kept getting more and more expensive. And things which were undervalued, such as gold and silver, they kept going down and down and down and down, and to no end. And it was just incredible. But the thing is, look, I claim, and that's something that I don't think many economists would even agree with me, that there needs to be some kind of a balance, some kind of proportion between the different asset classes and between commodities and the stock market, the bond market. And I'll try to explain very shortly, very briefly, why. Because take, for instance, let's assume that you're a tech company and that you're manufacturing iPhones, smartphones, yes? And there's just a tiny bit of silver and gold in each and every one of them. I once read a research that claimed that on average, in every smartphone, there are 30 milligrams of gold and 100 milligrams of silver. And those metals, of course, they are crucial for the production of electronic circuits. Yes, so you can't manufacture those gadgets without having a bit of gold and a bit of silver. Now, I don't know, perhaps they can come up with a way to reduce the amount of gold or reduce the amount of silver in those gadgets if they don't have access to those metals. But right now, that is not the case. That would require a lot of development and changing the entire way that they manufacture them. So right now, they need them. So just think for yourself, just imagine a situation in which your company is worth trillions of dollars. Just take what we've had in the past decade and extend it into the future. And you take a company like Apple, and it has a market cap of trillions and trillions of dollars, and has trillions of just free cash flow. Yes, it has an infinite amount of money at its disposal, and there's gold and silver there lying there, cheap, practically, or almost for nothing. Like according to my estimates, because the data is not exactly available in the markets of precious metals markets. I concluded that it would only take about $120 billion to buy all the available silver, which is in coin and bar form, investment grade silver out there currently. So, like a company like Apple can just go and just buy it all, theoretically. Now, of course, it can't buy it all, because as it tries to buy it all, the price is going to shoot up. But at least it can try, and it can actually buy a large chunk of that silver before the price reacts and starts shooting up. And why would Apple do that? Well, first of all, because it needs to ensure that it will have gold and silver in the future to manufacture its own iPhones, but also because it's tempting to try and take that silver and gold away from other tech companies so that they can't manufacture their iPhone, their smartphones or other gadgets. And this way they can become a monopoly in the market. So the more the discrepancy between the stock market and the commodity markets grows, the bigger this temptation becomes. And people talk about 1970s, 1980, when the Hunt brothers tried to corner the silver market, and they blame it on them that they've seen a huge spike in the price. And I claim no, it's not their fault. It was simply, if it weren't them, the price was too cheap. The price of silver back then was too cheap. It was tempting to try and corner the market. And if it weren't them, then someone else would do it.
Somebody else. Yeah.
Okay. So it's you would have someone trying to corner the market either way. It's the problem was not the Hunt brothers. They were the patsies. Yeah, they blamed it on them.
Right.
The problem is the imbalance in the market. This is the word you need to keep in mind. Imbalance in the market. Now, the thing is, every imbalance, it's like vacuum. Yeah, nature doesn't like vacuum. Yeah, nature tries to resolve it. And the same thing in economics. You can't have such a huge imbalance between the commodity sector and the rest of asset classes, because, you know, it's very tempting. Once you have so much free cash, you have so much cash in the bank, so it's tempting to go and just buy those commodities. Why don't we just do it? So this is the imbalance which the Fed has created. And if you'll allow me, I have this like idea in my head, like this picture that I want to share with your listeners. Now, if they want to try to visualize it and how it is right now in the market, just imagine that the Federal Reserve has erected an aquarium, right? And it starts filling it with water. And of course, those water is QE, it's the dollars that they're creating out of nothing. And at a certain point, that aquarium, you know, it tops up, it's full. So they raise the walls, the glass walls, they raise them a bit further, and they continue to fill it up with more water, and they go on doing that for 10 years. And the aquarium goes higher and higher and higher, and it becomes this incredible tower filled with water all the way to the sky. You understand what happens then? At a certain point, the weight of the water is so great that the glass walls begin to shatter. They begin to crack, and the water begins to leak out. And this is what, you have to imagine, there are two aquariums. The stock market is this huge aquarium all the way to the sky. And the commodities market, it's a tiny aquarium all the way down there. It's no water in it whatsoever. It's practically empty. Okay, and the water right now is cracking. The glass is shattering, and the water is seeping out. And the water wants to go to the other aquarium because of the imbalance between the two. Yes, and this is the way you need to picture it. Now, it's terrifying. It's terrible, because it means when the aquarium shatters, all the water starts flowing, and you can't stop it. That's where we are right now. It's huge inflation. But this is the meaning of hyperinflation. When the price of commodities start rising, it's like the self-fulfilling prophecy. Okay, so people see that the price of commodities is rising. Okay, so they want to move more money to the commodity sector. So prices rise more. So they want to move more. And you've already created this imbalance. Now the water needs to level somehow. And now we're going to pay for all the money printing we've had in the past decade. There was a huge lag. Years and years of lag, and we're going to pay for it now.
Yeah, and it was like delayed.
This is what I think.
Yeah, no, and they've done everything they can to perpetuate the inevitable. Yes. But at some point, well, like you said, that's a great analogy, Oren. That when that aquarium burst, there's no stopping it, right? And it could be a scary time. You know, the other thing that came to mind when you were talking was just just to talk about silver. To me, it's also mind-boggling when you talk about the little aquarium down there. That's the commodities and natural resources. The entire annual production of silver is worth $20 billion. And when you compare that size of that tiny little aquarium to any of the other, the market cap of the tech stocks, the market cap, and what I find fascinating about that is that even though silver is just this little tiny, little bitty market, and nobody really talks about silver in particular, when you go to Yahoo Finance and you look at the ticker across the top, they've got the Dow, the S&P, the 10-year bond yield, but they've got silver up there still, and they have gold up there. And even if you watch CNBC, which I don't watch a lot of CNBC, but they still show the silver price on the screen. I'm like, why do they show this little $20 billion market that's, you know, a fraction of the market cap of Apple or Home Depot here in the United States, our big hardware store? Why do they show, you know, why do they show that?
I think they do it out of tradition. I don't think they themselves understand the importance of gold and silver. It's because there was a time in which people used to invest in gold and silver, and it's just inertia. It's just they're used to showing them along with other things, so they go on doing that. Although nobody in Wall Street treats precious metals seriously. I don't think, I think most of them are completely unaware of their importance in the global economy. Or they don't think of them as money. They think of them as commodities, and you know, not even particularly interesting commodities.
No. Well, I think part of that in the United States is because, you know, was it 1933, President Roosevelt made it illegal for Americans to own gold. And then in 71, Nixon took the United States off the gold standard, took silver out of the coinage, and then just shortly thereafter made it legal for Americans to own gold. But if you think about, really since 1933, it was either illegal to own gold, and then just when it became legal again, well, they took it, you know, they went on a big campaign, they divorced the US dollar from silver and gold. So we've had like 100 years of basically, how do I say this, not a very conducive environment for in America for people. You know, like my grandpa never told me anything, and he was a smart guy, read the Wall Street Journal every day. Did, you know, he never said anything to me about silver or gold. That it's been kind of divorced from the consciousness of a lot of the Western countries. But I know when you go to places like China, India, other places in the world, it's kind of the inverse of that, where it's part of their culture and still regarded as a very important investment vehicle.
Yes, and you know, speaking from a culture that has no connection to gold and silver at all. I mean, like here in Israel, there was never a point in time in which our currency was made of silver or gold. We never had that. And so people are just, and there's a very high value-added tax here in Israel on purchasing the metals. They're treated just like any other product or any other commodity, and they're not treated as a legitimate investment. And it's completely, you know, the culture. It's non-existent. And you have that memory. You have that memory of silver being money. It's still ingrained that you know, somewhere in the unconscious. And of course, it exists in countries like China and India, because they've been battling inflation for generations. So they're used to purchasing gold and now even more silver. Because it has entered the culture. We in the West have suffered inflation in let's say post World War II. We had inflation during the 70s, and since then we didn't have any meaningful, again, prices, consumer prices didn't rise. It's not that we don't have inflation. Inflation, it's the increase in the money supply. The money supply increases all the time, but we've had enough growth to offset it, and we didn't see it in the supermarket. It didn't, especially as we said, in the past 10 years, all the newly created money didn't flow into commodities, so we didn't see it with our own eyes. So again, we've had inflation. You know, in living memory, only in the 70s. Those of us who are old enough to remember, and now. So we need to learn again the meaning of inflation and how to deal with inflation in our daily lives. And regrettably, it's going to happen in a very painful way. because a lot, it has to happen in a painful way, because I'm sorry to say, but the human beings, they learn things only by getting slapped across the face.
Better
beat up, like really badly. And then after they get beat up really badly, maybe they learn the lesson, but not beforehand. And now we've already been slapped once in the inflation we've had in the, especially 2020, 2021. That was the first slap, and we haven't learned the lesson yet. We need to receive a few more slaps like that. Yeah. And people need to realize, although inflation has somewhat subsided, I mean, the CPI increase, inflation always comes in waves. This is the historical lessons. It always comes in waves, because you have a bit of inflation and the Fed reacts. So the market's like, well, okay, the Fed is raising rates, so maybe it's not such a big deal. And then you have a crisis, and the Fed again slashes interest rates, and then inflation goes up again. But it doesn't go up from zero like it was previously. It goes up from a higher point, right? Yeah. So now we've had inflation from 2020 to 2021 or 2022. It's going up from practically zero, to 9%. I think we had at the top something like that in the United States. And then it went down. Right now it's around 4%, something like that. So the next round is going to go from 4 to 13%.
Yeah.
Right?
No, I agree with that. I think that when the
Fed...
Just
a second, just let me finish. Yeah. There's going to be lots of waves like that. Another wave and another wave. At some point, people are going to realize that commodities are the answer, because commodities are the only asset class which is currently undervalued. Yeah. So they're there. They're just waiting for the money to flow in that direction. And unfortunately, it means also that our basic commodities, basic staple foods, basic consumer goods are going to rise as well. It's not good. It's not going to be fun. It's not like, when the Fed is printing money and the S&P 500 goes up, everybody's happy. Next time when the Fed prints again, everybody's going to feel it in the supermarket. It's going to be very painful. And this is what I mean when I say you're going to get slapped. And people are going to have to learn the hard way that gold and silver are the little guys' only chance to battle with inflation. Because, perhaps the big guys, perhaps they know, sophisticated investors, they know how to buy futures, oil futures, futures on wheat, rice, soybeans, all these stuff. Orange juice, I've heard that lately it has gone up tremendously. So, but as a simple guy, as a simple person who doesn't know how to trade the futures contracts, what can you do? What kind of access do you have to the commodity sector? There's only one way. You're not going to buy, barrels of oil, right, and store them in your basement, right, Ron?
Right.
You don't want to fill it up with barrels of oil. There's only one way for the simple guy to get an exposure to the commodity market, and that is through physical gold and silver. It's not hard to figure out. Come on.
Right. Nope. I agree with you. And it feels like living here. I live right in the middle of the United States in St. Louis, and I get a good feel for the whole country. And I'd say that most people here are living in a fantasy world, and they don't have any idea about what's coming. The people that have joined us on this video from all over the world, but those from the US, they are aware, right? They're interested. They want to dig in and learn, but most people don't care. And I agree with you 100% that there's no better teacher in life than pain, right? So when they get slapped again and get slapped again, then they'll start to wake up and think, maybe I should get some silver, maybe I should get some gold. But the problem will be, Oren, that even if we look back just to March and April of this year, I can tell you here in the United States, when we had the little banking crisis that got papered over, you couldn't find especially physical silver it was gone quick. It was immediate. It was not available, right? You'd wait a month. So, you know, I like to be prepared. I think a lot of the people that are joining us have been prepared. And I think that what you explained to us today, as we talked, in the knowledge that you share with us, we started out by asking, are we crazy? I don't think we are crazy, right? I think that we're in a position.
Early. We're not crazy. Okay, my grandmother, my late grandmother, she had a saying, when you're one step before everyone else, you are considered to be a genius. When you're two steps ahead of everyone else, you're considered to be a madman. You're crazy.
So hopefully we will transition from madman, crazy to genius here, and it feels like to me, we're in that process.
We were just early, very, very early. But still,
I've heard
was correct.
Yeah, and I've heard people say being early sometimes feels a lot like being wrong as well, right? And you know, so you know, but what I like, what I go back to, especially with physical silver, and I'm invested in the precious metal mining stocks as well, is when I look at like physical silver, I think, when I look at the risk profile, I see it as an asymmetric risk. I think, you know, sure, physical silver could go down a little bit, right? I mean, but boy, the upside potential, not just as measured in fiat money, whatever currency you want to use, is really extraordinary, but also from like an insurance or a safety perspective as well. Like, I feel like the upside potential is so much more on many different levels than whatever little bit of downside. I just can't see a day when silver's not in real terms valuable.
Yeah, I want to tell you about that that idea that if you're early, you're wrong. In Wall Street, they have this saying, if you're early, then you're wrong. That's because they live in a very short time span. They have their thinking is always very short term. They have to give results this quarter, right? This year. And if they don't show results right here and right now, then they get fired. I don't know, or their clients leave them. But that's the thing. But if you and I we can look a bit further into the future. If we have a bit more patience, then we're not wrong, because our time horizon is longer. Yes, we think to the long term. And you know, right now it's frustrating. Right now people are really pissed because, you know, we've had the inflation, the promised inflation, and gold and silver didn't do what they were supposed to do. They let us down. That's the feeling that I get from people around. So the thing is that if you're able to hold on, then perhaps you're going to get paid, you're going to get compensated for that waiting. And that compensation is going to be, you know, huge. It's going to be great, far greater than you could have imagined, and perhaps far greater. Of course, we can't promise anything. You know, we don't have a crystal ball, and we don't predict the future, and none of what we're saying is financial advice, and you know, all that, because we're not financial advisors. But I can only tell you my personal belief, and I still believe that gold and silver will deliver. In the end, it's going to be a very painful, long journey, but we're going to find the promised land eventually. Yes, we're going to get to some kind of safe haven. And I think only in hindsight, people will understand that we were right after all. I still believe that. And this is why I continue to stack.
Well, Oren, on behalf of everyone who's joined us today, it's been great hearing from you, learning from you. I want to remind everyone that they can check out more of your content at your YouTube channel at silverhermit.com. And in the description of this video, I'm going to put some other links to your Substack and other ways people can learn about you. This has been great. I want to say thank you for joining me in the basement.
I want to say thank you. I feel privileged talking to you, really, because, you know, it's like getting in touch, you know, people that you've only seen on YouTube. and suddenly you get to talk to them. That's it. That's fun. I really enjoy that. It's a unique experience.
Yeah, I feel like I have a new friend. And I also feel like that a lot of people that have joined us today feel like they have a new friend as well. So
thank you very much.
Well, you're very welcome. We appreciate it. And we will definitely see you again in the basement. You never know, you may be here in person sometime as well, Oren. Thank you, my friend.
Thank you very much. And thank you to all your viewers too.